Kia ora ana, tātou katoa, tēnā koutou katoa, and welcome to our monetary policy press release. A belated Happy New Year to all of those who have joined us for the first time in this calendar year 2022. I'm joined here, as usual, with Yung Ha, our Chief Economist, and Christian Hawkesby, the Deputy Governor of the Reserve Bank, and the broader Monetary Policy Committee, who aren't here in person but are online with us observing. I want to thank them for their considerations and efforts over the last week or so. Today, we tightened the official cash rate to 1.0%. The committee also agreed to commence the gradual reduction of the Reserve Bank's bond holdings under the large-scale asset purchase program. This scaling down will be through both bond maturities and a managed sales process. The committee agreed it remains appropriate to continue to reduce the level of monetary stimulus in the economy so as to maintain price stability and support maximum sustainable employment. The level of global economic activity is generating rising inflation pressures, and these have been exacerbated by very clear ongoing supply disruptions. The pace of economic growth has slowed globally, in large part due to the continued elevated uncertainty created by the persistent impacts of the COVID-19 virus, as well as clear signals that monetary conditions globally are set to tighten over the course of 2022. In New Zealand, underlying economic strength remains in the economy, in particular supported by aggregate household and business balance sheets, which remain strong, fiscal support which continues, and our continued strong export returns. However, some short-term economic disruption is expected to continue given the current growing COVID-19 health challenge in front of New Zealand. The high vaccination rates that we have across New Zealand will assist greatly in reducing this disruption. Economic capacity pressures have continued to tighten. We believe employment is now above its maximum sustainable level, and there is a broad range of economic indicators highlighting that the New Zealand economy continues to perform at or above its current potential growth rate. Headline CPI inflation is well above our target range, but we are confident it will return to the 2% midpoint over coming years. The near-term rise in inflation pressures are being accentuated by high imported costs, in particular higher oil prices, rising transport costs, and the impact of supply shortfalls for many resources. These immediate relative price movements do risk generating more generalised price rises, and especially so in the current environment of domestic capacity constraints. So on balance, the committee agreed that the further removal of monetary stimulus should be expected over time, given the medium-term outlook for growth and employment and the upside risk to inflation. Me taki mai tā, we are here and open to questions.
Here. House prices, can you hear me okay? House prices you're expecting to fall by 9% over the next couple of years. Can you talk us through that a bit? And is that at the right speed in terms of fall without it hurting the economy too much, or what are your thoughts on that?
Yung, would you like to talk to that?
Yeah, I mean, house prices, asset prices are notoriously difficult to forecast. We've said the very high levels of house prices we've observed over recent times have been unsustainable. We're now starting to see signs that actually house prices are declining, or the rate of increase is falling. That's probably bringing them back into more sustainable levels given the outlook for both demand and supply. So we have a working assumption, or a technical projection if you like, that they decline by about 9% over the next 2 to 3 years, but time will tell whether that comes to pass.
And I probably would just say we're more confident in the direction rather than the magnitude.
And is that at the right speed, do you think, without it being too much of a shock to the economy?
I'm sorry, you're coming through very poorly. We can't hear you.
Sorry, it's probably... Is that at the right speed, do you think, without it being too much of a shock to the economy?
In terms of financial stability, we're very confident that financial institutions are in a sound position to manage adjustments to house prices. Likewise, household balance sheets on aggregate are very robust. We see that homeowners, householders have significant, I'm talking on average, significant equity in their homes, and the types of price changes we're talking about are very small relative to the price increases we have observed recently. But there will be small pockets of New Zealanders who, particularly those who have recently taken on large levels of debt, who will be in a position where they may need to manage negative equity in their home for some time. But interest rates remain low. Banks should have been testing people's ability to weather a broad range of interest rates. So we're confident that the economy will manage through this.
Next question. Oh, Brent Edwards, NBR.
Oh, okay. Can you hear me right? In terms of employment, you talk about it being above the sustainable rate now. So presumably you think there needs to be a rise in unemployment. And if so, what rate of unemployment would meet the bank's mandate?
We don't target a particular level of unemployment. And what we're saying in this side is that employment growth remains positive, but the labour supply is increasing through time. So as you are well aware, we have a wide range of measures around what we see as a maximum sustainable employment level. All of those measures are currently saying that it is very tight, the labour market.
Next question, Sophia Rodriguez, Central Banking Intel.
Yeah. Good afternoon, Mr. Orr. I liked your chapter on inflation expectations, and I was wondering what kind of level of long-term inflation expectations would start worrying you. And I'm asking this because short-term inflation expectations seem too high, and if as a household I look at those inflation expectations, I go to a supermarket and I think the RBNZ doesn't seem to be doing enough to bring inflation to the target soon, which means I will rather stock on more goods. I'm just trying to talk like a consumer, but I'm just wondering, how does that play into your inflation expectations management?
Yeah, wonderful and great question. You've explained exactly some of the fears and paranoias as central bankers should have. That is where the observation of current high inflation leads to expectations of permanently higher inflation. So our task is to make sure that longer term inflation expectations remain anchored around the midpoint of our target band. Currently, the high inflation expectations you refer to are very near-term inflation. Expectations. We can explain that more or less by just current prices. So people are basing a very near-term expectation on what they currently observe. The important ones for us are more in the 5-10 year ahead inflation expectations, which remain very well anchored, but they have risen somewhat from the midpoint of our target. So this is why we are acting now, to make sure that people remain confident that the Reserve Bank is here to do its role, and it will do its role with regards to slowing aggregate demand until inflation expectations settle back down again. There is nothing we could do without creating unnecessary instability in output, interest rates, exchange rates, about the prices you are experiencing right here today. We are thinking about over the medium term.
Next question, Janae Tibshine, Interest.
Hello, Janae Tibshine from interest.co.nz. Just a question about the LSAP. I don't suppose the Reserve Bank could provide an indication of how it expects debt management's forecast debt issuance program to change due to the decision to reduce the size of the bond holdings?
Yeah, thank you, Janae, and I'll pass over to Christian, who has been in close contact.
Yeah, no, that's right. So thanks, Janae. So as we outlined in the document, we will be running down the LSAP portfolio. That's something that's been well flagged that we would provide those details. Over the past few months, we've been liaising very closely with New Zealand Debt Management about what the best way to do that is. And that sat behind our judgments around how quickly we could do that over coming years. One of our key objectives is to not harm the functioning of markets while we undertake this process, and judge that selling the bonds back to New Zealand Debt Management was the most effective way to do that, in part because it provides certainty to markets about the net supply of bonds into the market, which can be determined by New Zealand Debt Management. They'll be outlining the implications for their funding program in the upcoming half-yearly update, and we've indicated that we're looking to sell into the second half of this year, such that it falls into that window where they're normally providing that clarity to markets.
Thank you. Just two follow-ups on that. Is it safe to assume that at the rate the Reserve Bank has suggested it would like to sell the bonds back, that debt management would have to issue more debt than it would otherwise have done?
Ultimately, the mechanics of this is that the Crown has a deposit account with us, the Crown settlement account. So that's the mechanics through which that they would purchase the bonds, by using their settlement account. All else equal, they would have to find that funding. So if they don't want to pay for them out of their settlement account, all else equal, they would be issuing more bonds into the market to fund that. That's a decision for them. That's something that they'll clarify in the half-yearly update.
Thank you. And just one more thing on that, and excuse my ignorance with this, but what happens to the proceeds if the Reserve Bank's not going to reinvest them? Then what happens to them?
Ultimately, what occurs is a shrinking of our balance sheet. So ultimately, we will have less government bonds on the asset side of our balance sheet, and either less Crown settlement balances or bank settlement balances on the liability side of our balance sheet.
And I think underlying this, and the great questions underlying this, is really the key point that it's the New Zealand government, through their fiscal policy, wants and needs that determines the level of bonds they need to issue. It's independent of whether we are one of the people purchasing or not. So, it really comes down to what else is happening with regards to the fiscal needs at the time.
Next question, Tom Polistrakis, Stuff, and then Stephen.
It says that the decision on whether to raise by 25 basis points or 50 basis points was sort of finely balanced. I mean, does that mean that there's a significant chance of? Oh, sorry, can you hear me now?
Yep, you're still fine.
Yep. Oh, yeah, great. Oh, you did. Oh, great. Does that mean that there's a sort of significant chance of, or possibility of 50 basis point rises, through this year, or is the fact that we've now got more, shorter gaps between MPSs and reduce the likelihood of that? And just a second question, perhaps, if you're saying sort of employment is above maximum sustainable level, I mean, what does that mean in practice? I mean, does that mean that there are people employed at the moment who shouldn't be?
So taking your first question first, we, like I imagine any decision maker does not want to rule out the optionality of the sizes of the moves that we may need to make with regard to interest rates in the future. What we've outlined today very clearly is that where we see the end outcome for interest rates in our projection is significantly north of where the official cash rate currently is. That means that we still have work to do, and the markets see that also, and so the mortgage interest rates are already pricing in that forward look for us. We need to observe both the economy and how market pricing is behaving through time to assess whether we're having the impact we need to maintain inflation, and so we will not rule out larger moves in the future. It's going to be a function of what is necessary and other shocks that happen at the time. So that is the discussion. I'm very pleased you mentioned that, you know, there are frequent opportunities for us to reassess and change interest rates, and we want to manage monetary policy in a way that doesn't unnecessarily lead to volatility in outputs, interest rates and the exchange rate. So we're being clear forward guidance around the work ahead of us, retaining optionality, but taking our time step by step and bringing you along with us on the way. On the employment level that you said, no, what we are saying is that at the current level of employment, inflation pressures are growing. And that means that that employment can continue to grow, but it may not grow as fast as labour supply is coming on in the future. So it's not about those currently in work, it's about can we continue to create jobs fast enough or faster than the supply of labour, and can we do that in a way that doesn't generate generalised inflation?
Okay, thanks. And sorry, just one more question, just the reference to the Ukraine in the paper. Your sort of basic thinking is if tensions escalate there, that's inflationary, so it might lead to a sort of higher OCR than otherwise. Is that right? Is that your thinking? Because I guess, you know, significant tensions there could also create a sort of recession, perhaps particularly in Europe, and perhaps lead things in the other directions. So, I mean, is it sort of clear cut what escalation of tensions means?
Good. Yeah, good question. I assume you're talking about the geopolitical tensions, the current Ukrainian challenge. I mean, these, for a start, these, you know, this is yet another economic shock or unanticipated event from as recent as 3-6 months ago. These things will always continue to happen. You are correct, there are both demand impacts and also supply side impacts. Our job is to work our way through what matters for us here in Aotearoa, New Zealand, on net balance for inflation through time. At the moment, there are clear one-off price impacts of the uncertainty being primarily the global oil price. The good news is that there's already a lot of this concern priced into current oil prices, but we need to be aware of what that means for near-term measured inflation, but more importantly, longer-term inflation impacts. It can happen through lower real incomes because of higher oil prices, or it could happen through higher inflation expectations because of higher current inflation. We need to focus on those medium-term inflation expectations.
Next question, Stephen Wright, Wall Street Journal.
Hi, Adrian. So much of the extra tightening that you are forecasting is backloaded into 2023. So I wonder what sort of conditions or things you would want to see to bring some of that forward into this year.
Yeah, Yong or Krishna, do you want to chat about the discussions we had?
I mean, yeah, basically the projections lay out a picture where inflation pressures are stronger, so it shows up in the forecast track for the OCR. So that now peaks at 3.4%, previously 2.75%. So the message conveying there is more work, more monetary tightening required to ensure that inflation eventually settles back to the midpoint of the band. What that means for each subsequent OCR decision at 6 weekly intervals is something for the committee to debate at each point in time.
And also, just to clarify, our official cash rate track is actually front-loaded into this year. So most of that work in our predictions is done over the course of the next 12 months, with more to come after that.
Next question, Bernard Hickey.
This is a question for the Governor on the relative work that the official cash rate is doing to tighten monetary policy and the work that's being done by the LSAP saleback program, the $5 billion. Can you give us a sense of, how much of the work is being done by the LSAP reversal and how much is being done by the OCR?
I would be very confident to say the vast bulk is done by the official cash rate, and that the current level of additional stimulus and the future withdrawal of that stimulus through the LSAP program is very small. This is why we have the confidence that we can both allow these bonds to mature and have a sales process back to the New Zealand Treasury without creating any particular impost on longer term interest rates. So it's all about the official cash rate.
So so does that mean that you wouldn't necessarily use that any changes in that $5 billion plan as a way to tighten or loosen your track going forward? It's going to be $5 billion to give certainty, and now all the work is the OCR.
Yes, that's correct. We want to express our desires for future interest rates using the official cash rate and express our actions through changes to the official cash rate. So it's back to business as usual. And in the background, we're doing the mechanical process with regards to the large-scale asset purchase program. It has been effective, and we are now in a wonderful position that we can start removing it and just using our traditional tool.
Can I ask one final question about the fall in interest rates and the LSAP program and its effect on asset prices? Treasury told a select committee last week that its views had changed, that it now saw the big fall in interest rates as a major driver of the rise in house prices. And I wonder if you shared that view and whether the Reserve Bank sees itself as responsible or in any way having to think about the effect on house prices from its monetary policy.
Yes, thank you. I think you've been economic with the full quote of Treasury there, but a nice goading. What Treasury, and in fact it was collective work they're referring to, work that we're also involved in, is that over a long period of time, and they're talking a couple of decades, we have gone through globally, that was a key word you missed, globally, a secular decline in nominal interest rates. That's an international decline around which New Zealand has zero influence. That is determined by the large economies and long-run impacts such as demographic factors and fiscal policy situations, things that determine long-term real interest rates at the international level. That has been the key driver of asset prices globally, and including New Zealand asset prices. Now, within New Zealand asset prices, the most sensitive asset to these interest rate movements has been housing and housing, because that's where most of the weight of capital in Aotearoa New Zealand equity is in the form of housing. So the global decline has been the big driver. Secondary to that, and a very small secondary, is what the Reserve Bank with its own monetary policy has done relative to that international level. So yes, we have a small impact at the margin as to whether we are higher or lower than the international interest rate, but it's the global decline in nominal rates that Treasury and ourselves are referring to when you talk about that. Just stepping back, we absolutely know that monetary policy, shifting interest rates, shifts relative prices, shifts the desire to spend or invest. That is the role of monetary policy. And through that, it will have impacts on many things, including asset prices. The severe shift you've seen, or significant shift in house price in New Zealand, have been through those longer term declines and the important fact that house building just never kept up with population growth in New Zealand.
Thank you.
The next question, Matthew Brockett, Bloomberg. Then Brian.
Thank you. I just want to ask about the new OCR track. You've obviously got it going now considerably above what would be considered a neutral OCR, and you seem a lot more concerned about inflation than you are about the potential downside risks to the economy. Could you explain what gives you confidence that the economy can cope with that magnitude of monetary tightening at a time when there's obviously pretty heightened economic uncertainty?
Such a broad range. I think we tried to explain that through our monetary policy statement, and short of rereading that, do you want to provide any comments?
I'd just say, what we've learned through the pandemic, COVID, is, initially it was the biggest fears were around the resilience of economic demand, but actually the range of policies has supported household and firms' balance sheets. Demand has actually been proven reasonably resilient, not just in New Zealand, but globally. And the challenges we're now facing is around the emerging inflationary pressures. So our mandate is around inflation and employment. On both those metrics, we are now above our respective targets, and hence the direction for monetary policy is pretty clear.
So how concerned are you that, faster inflation does become embedded? Are you more concerned about things like rising inflation expectations?
Sufficiently concerned to be tightening monetary conditions today and signalling that we will for some time yet until we aren't concerned. So, that is, we're in a wonderful positive position of being what I would call being back to business as usual. The economy is growing at a pace faster than it can sustain, and we are managing demand side, to achieve our inflation objectives. So it's a very I would say, constructive and positive side to be on with regards to monetary policy.
Brian Fellow, NZ Herald. Get you to start again there, Brian. You're on mute.
Do I need to do anything?
You're right now.
Okay. Sorry about that. One of your projections is that labour productivity will trend around 0.9% a year over the next few years, which is a better rate than we've seen for quite a while. I'm wondering why you're so confident in that number, and how sensitive your projections for both GDP growth and, for that matter, inflation are to that assumption.
Yeah, I'm
I guess
giving you lots of opportunities there. Yeah.
Yeah, I mean, it is an observation there, but higher levels of investment, we feel that will contribute to slightly higher levels of productivity. But you're right, we have observed pretty low productivity in recent history. That seems to be the missing piece of the puzzle in terms of broader improvement in living standards in New Zealand.
And just a sense, Brian, just around, how certain we are or not, it's an estimate. Really what we have to do is learn by doing. Assessing and allowing the economy to reach these, sense of capacity pressures, and that gives us almost a reverse sense of what is the potential growth rate and productivity rates of the economy. The investment levels, we do have had significant investment, forecast significant investment, but also the adoption of current technologies and productivity moves sit in there. But it remains an estimate.
But I mean, if that estimate proves too generous, would you have to revise down your expectations for growth and maybe revise up your expectations for inflation?
That's correct. That's correct. One of the single biggest challenges, and you're putting your finger well on it here, has been the aggregate demand. We measure almost real time and can see through spending stats the ability to supply is not as obvious, and it's been the supply constraints over recent months and quarters that is being the biggest hold up on the ability to grow without inflation. And so, the world is now in a position where demand has remained robust, but supply is struggling to keep pace for all of the well-known reasons.
Next question, Janae, and then Bernard.
Thank you. Two things. Firstly, has the Reserve Bank changed the model that it uses to forecast house prices in the same way that Treasury has as of the haifu last year?
No.
Okay. And secondly, would you be able to just explain a bit more why quantitative tightening won't have much of an effect on, monetary policy, or why? I understand what you're saying, that OCR is going to be the main tool that you're going to use, but why won't the tightening have much of an impact?
I think the easiest way to get around it is thinking about why it had such a large impact to begin with. And by the way, I will refer you to some very well articulated parts of the document and our record of the meeting that outlines the mechanical side. But when you think about it, we wanted to arrive with these bond purchases with a very loud splash, and then we wanted to get out of that liquidity pool using the ladder, leaving very little ripples beyond. We achieved that by announcing and making significant bond purchases for the first time. You get, as we are doing it up front, you get the lowering of the interest rates. But then we stopped, and that level of impact just has teetered out to something quite small. So as we're leaving, all we're doing is reducing the risk of something quite small. I'm sorry for speaking in such simple terms, but it is no more complex than that.
Next question, Bernard Hickey.
I've got people here who could make it more complex if you want to.
Thank you. A question on wages. I liked the section on wages and a very interesting and colourful chart, which showed that the percentage of people getting 3 to 5% wage increases is significantly lower than the last time we saw inflation take off. Can you give us a sense of whether the wage inflation, which in theory should result from all of the labour shortages, whether that's actually coming through yet?
Can I just differentiate a couple of things there? The first one is about a relative price shift, the relative price for labour as it becomes scarce. That is a natural part of the labour market working. If labour is short, then you may see these relative one-off price shifts. For it to become then more generalised across the economy and then lead into price-setting behaviours, etc., that becomes a secondary impact and then becomes of more interest to the Reserve Bank. So that chart you're looking at is in large part around relative wage shifts. And actual nominal wage sides at the moment, we've seen them rise as anticipated. The growth in nominal wages remain low from what we've seen in quite recent economic history during these stages of economic tightness. And the nominal wages are still running behind the current inflation at the moment. So in a sense, the market is working as we would anticipate in that labour market.
Yeah, that's absolutely right.
Sorry.
And just to back up the Governor's point, where we're seeing the largest wage rises is in those sectors where we're seeing the tightest capacity constraints. So there's a consistency there in terms of how that's manifesting itself in wage growth.
And just finally, on the balanced decision between 25 basis points or 50 basis points, how much of a factor was the current and potential disruption of the Omicron surge in the decision whether or not to go with 25 or 50?
Yeah, it certainly sat there as one of the things we thought about. We've outlined quite clearly. A plus 50 was all about inflation expectations, a stitch in time. A plus 25 was more about we've already done a lot, there's a lot priced in, there's a lot of sides there, and we have time to observe the health outcomes of the current environment that we're in here in New Zealand. The broad story in our projections is an incredibly positive one relative to 18 months ago, 2 years ago, in that we now have a highly vaccinated population. Yes, we are going through this peak, but yes, we can also see the other side of it around far more liberal movements of resources, people, activity. That is well within line of sight now, within weeks, months, quarters. 18 months ago, it was an unknown.
Thank you.
We have a question here from Cecile Lafort at AFR. She's having trouble joining, but she's asked, what are your thoughts on the NZ dollar level? It has remained subdued despite a higher OCR rate. Do you expect this undertone to continue?
We have no expectations of where the exchange rate will go. We have no direct influence over that, and it's a relative concept, us relative to the rest of the world. We do note in the document that interest rate differentials between New Zealand and the rest of the world have narrowed over recent times, and that's because monetary policy in many of our trading partners are starting to look more like what we've been doing, which is tighten monetary conditions.
Any final questions?
Thank you.
So one from Katie Bradford, final question.
Just touching on what Bernard was asking about there around the economic outlook over the next few months, once the Omicron peak is over, how worried are you that we may not have the bounce back that we have seen in the past couple of years post lockdowns and so forth? What sort of activity are you expecting?
I would have to say please not worried about an absence of a bounce back, because that would mean we didn't fall into a big hole. So at the moment, we're looking at some economic disruption. We're not talking anything like what we saw, through the initial lockdown period. Then beyond that, I think that people are forward-looking in their planning, in their expectations. They have been told and are aware that borders are reopening internationally, restrictions are declining, populations are being more vaccinated. So, I just feel so much more confident where we are today than where we were T-minus 18 months ago. We are going to go through some disruption. We all know that, but we can see the horizon on us around a return to more normal than what we have in front of us over the next few weeks. So I just want to say thank you very, very much for the questions, and I want to give a special thanks, noting the cover of our monetary policy statement. I'll hold it up the right way this time. Has this beautiful diagram. That beautiful diagram is of the Basin Reserve Cricket Ground here in Aotearoa, New Zealand, Wellington. It's there to recognise our Chief Economist Yung Ha's love and passion for cricket, and the fact that your next career move, Yung, is to get 2 new young black caps ready to defend the honour of Aotearoa, New Zealand. I want to thank you from all of our committee members and from the Reserve Bank of New Zealand for the magnificent contribution you've made. Good sir.
Yeah.
Cool. No pressure on him. We hope to see his family out there soon. Kia ora, thank you very much.